welcome to ESSSuper's annual members meeting for the 2024 to 2025 financial year. My name is Christian Koong and I'm the Manager of Member Education here at ESSSuper. It's my pleasure to be your MC today. I'd like to begin by acknowledging the Wurundjeri people of the Kulin Nation, the traditional owners on the land on which we meet, and pay my respects to their elders past and present. I extend that respect to all Aboriginal and Torres Strait Islander people attending today. Thank you to everyone that's joining us online and in person. It's wonderful to have so many members with us this afternoon. We really value this opportunity to connect, update you on the fund, and most importantly, answer your questions. ESSSuper Board members, our executive team, and auditors and actuary are present today. For our online audience, you can maximise your screen using the expander button on the top right-hand corner of the video. If you need assistance, please use the red live support icon in the top right corner. We'll hear from three speakers today. Joan Fitzpatrick, our Board President, Robbie Campo, our Chief Executive Officer, and Daniel Salutin, our Chief Investments Officer. The presentations will be followed by a question and answer session. Thank you to those that have submitted questions in advance. If you're here in person and would like to ask a question, please raise your hand once the question and answer session starts and a microphone will be brought to you. If you're attending online, you can ask a question at any time using the live Q&A function on the right-hand side of your screen. Simply type your question into the text box and click Submit. It's now my pleasure to introduce our Board President, Joan Fitzpatrick. Joan was appointed President of the ESSSuper Board on the 8th of February 2016. She is an accomplished company director and a successful business leader with over 40 years of experience across the corporate, government and non-for-profit sectors. She has an impressive track record of achieving strong engagement and success for business outcomes in complex change environments. Joan is the Chair of Catholic Church Insurance, of the Australian National Research Organisation for Women's Safety, of the Hardman Group, of the Larkfield Group, and of the AFL Players Association Injury and Support Fund, and a non-executive director of Defence Bank. In addition, she runs her private consulting business, Alviarium Proprietary Limited, and provides pro bono consulting to various charities and causes. She has a particular focus on mentoring women and championing women's equality in society. Joan is a qualified barrister and a fellow of both the Australian Institute of Company Directors and the Australian and New Zealand Institute of Insurance and Finance. She's a member of the Association of Superannuation Funds of Australia Limited, the Customer-Owned Banking Association, and Women in Super. Welcome, Joan.
Thanks very much, Christian, and good afternoon, everybody. I'd also like to begin by acknowledging the traditional owners and custodians of the lands on which we live, work and gather across Australia. Here in Melbourne, of course, we acknowledge the Wurundjeri people of the Eastern Kulin Nation, and we pay our respects to elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples who may be here today. We honour their stewardship and their continuing deep spiritual connection with country, and we commit ourselves to reconciliation and the cultural safety of all Aboriginal and Torres Strait Islander peoples. On behalf of the ESSSuper Board of Directors, many of whom are here this afternoon, I'd like to extend a very warm welcome to all ESSSuper members attending this annual members meeting. Whether you're here in the room or joining us online, we're delighted to have you with us. Your board is made up of an equal balance of directors elected by members and directors nominated by the Victorian Government. Together, we bring a diversity of skills, experience, and perspectives, but above all, a deep understanding of our members' needs. The board is supported by a number of specialist committees that provide additional oversight and focus on key areas. These strengthen governance and help ensure every decision made by the board is in the best interests of our members. We're fortunate to have 6 standing committees chaired by highly experienced directors who bring deep expertise and commitment to their roles. The Benefits and Services Committee is co-chaired by Angela Stringer and Colin Jones. The Finance and External Audit Committee is chaired by Michael Dundon. The Investment Committee is chaired by George Boberus. The Governance, Risk and Compliance Committee is chaired by Ben Mackay. The People and Capability Committee is chaired by Dean Blair. And the Transformation and Technology Committee is chaired by Pam Rebecca. I'd like to acknowledge their leadership and the important contribution these committees make in ensuring strong outcomes for our members. Together, this structure provides the insight, the accountability, and the focus needed to guide ESSSuper confidently into the future. This year marks a very special moment in ESSSuper's history. In 2025, the Emergency Services and State Superannuation Fund celebrates its 100th anniversary. The fund's origins can be traced back to the aftermath of the 1923 police strike, which sparked broader conversations about fair retirement benefits for those who serve the community. The original State Superannuation Fund was established soon after, providing retirement security for public servants and teachers. Over time, new schemes were created for police, firefighters, and ambulance officers, eventually coming together with the State Super Fund in 2005. That evolution has shaped who we are today, a fund with deep roots in the Victorian public sector and an enduring commitment to those who serve our community. This milestone gives us a moment to reflect. It's such a testament to the foresight and wisdom of so many people who came before us, and the thousands of members who have placed their trust in ESSSuper across a whole century. When I reflect on our origins and where we stand today, one theme stands out above all others, and that is service. Service by our members to the Victorian community, and service by ESSSuper staff across the years in helping them achieve the comfortable retirement they deserve. Today, we remain one of Australia's oldest and most highly rated superannuation funds. We're proud to support more than 121,000 members from Victoria Police, Ambulance Victoria, Fire Rescue Victoria, the transport sector, state schools, and the Victorian public sector. As a profit-to-member fund and an agency of the Victorian Government, we remain focused on delivering value, confidence, and strong retirement outcomes for every member we serve. I am soon to complete a decade as your board president. When I joined in 2016, ESSSuper was already a well-established fund with a strong sense of purpose. But over the past 10 years, the environment in which we operate has changed dramatically. We have responded to regulatory changes, embraced new technologies, and strengthened our governance frameworks. We've sharpened our strategic focus to help members navigate change, and significantly, we've restructured our operations to maintain high-quality service at notably low fees. During this time, we've also introduced new digital tools, modernized service delivery, and built deeper engagement with our members. These steps ensure that ESSSuper continues to deliver services that are high quality, really good value, and responsive to members' needs. We've also remained steadfast in delivering one of our most important responsibilities, protecting and growing our members' superannuation. Most of our members have access to ESSSuper's unique defined benefit schemes. These entitlements are built into members' employment conditions and are protected from the ups and downs of stock market performance. This means our members can look forward to greater financial certainty and typically retire with significantly higher retirement savings than most Australians. In fact, 78% of our active defined benefit members are on track to meet or exceed the ASFA comfortable retirement standard when they retire. That's well above the Australian average of just 30%. And last financial year, 64% of our members with a retirement income stream met or exceeded the same standard. For members in our accumulation plans, income streams, or beneficiary accounts, our investment performance has delivered strong long-term growth despite sometimes very volatile global conditions. Through challenges such as the global pandemic, rising inflation, and geopolitical instability, our investment strategy has really proved its worth. Our diversified options have achieved consistently strong results. Our Chief Investments Officer, Daniel Salutin, will speak later about this in more detail. While much has changed over the years, one thing has remained constant. Members tell us they value the service and that extra care they receive from ESSSuper. Our satisfaction scores consistently remain above 90%, and I'm especially pleased to share that in the Investment Trends 2025 Superfund Member Engagement Report, ESSSuper received the highest Net Promoter Score of all funds surveyed. This highlights the value our service provides and reflects our ongoing focus on member experience. This is a key priority for the board. We also continue to be recognised for the quality of our products. This year, Super Ratings once again awarded ESSSuper's income streams a platinum rating for the 17th consecutive year, I'm pleased to say, placing them in the top 25% of funds nationally. These results are a clear testament to the commitment of everyone at ESSSuper to put members first, always. Looking forward, I have great confidence in the future of this fund. Our 5-year strategy provides a clear roadmap to continue delivering on our purpose. It will ensure we remain a trusted, hybrid defined benefit and accumulation fund, while providing members with expert service, personalised support, and modern systems that make superannuation easier to understand and navigate. Of course, there's always more to be done. We never stop. And our CEO, Robbie Campo, will provide further information on the many projects and enhancement work that we currently have in train when she speaks. As I prepare to step down from the board in February 2026, I do so with immense pride in what we have achieved together and with confidence in the fund's leadership and direction. On behalf of the board, I would like to thank our CEO, Robbie Campo, for her excellent leadership and vision, thank our executive team members for their capability and strategic focus, and of course, thank the dedicated ESSSuper staff for their always high professionalism and great commitment. I also want to thank my fellow board members for their stewardship, guidance, and enduring focus on members. We are very grateful to the Victorian Government and the Department of Treasury and Finance for their ongoing support and wisdom. And of course, I want to thank you, our members, for your loyalty to the fund and for the vital work you do every day to protect, educate, and support the people of Victoria. It has been an honour to serve as your board president for a decade and a privilege to be part of ESSSuper's centenary year. Being the custodian of your retirement savings is a responsibility your board takes very seriously. We are proud to serve you and confident that ESSSuper will continue to deliver strong outcomes and secure futures for all our members for many years to come. Thank you.
Thank you very much, Joan. Our next speaker is the Chief Executive Officer of ESSSuper, Robbie Campo. Robbie joined ESSSuper as CEO in July 2022. She has worked as an executive in the superannuation industry for over 2.5 decades and has extensive experience in executive leadership, strategy, risk management, financial management, transformation, and public policy. Robbie is deeply committed to the fundamental purpose of superannuation, to maximise the retirement outcomes of Australians and ensure the hard-earned contributions made throughout their working lives create financial security for them in their post-working years. As Chair of Women in Super and membership organisations within the superannuation industry, a key priority for Robbie is to see systemic improvements in women's retirement outcomes. She holds a law degree with honours, a Bachelor of Arts and a Bachelor of Education, and a graduate diploma in applied finance and investments. She's also a graduate of the Australian Institute of Company Directors. Welcome, Robbie.
Thank you, Christian. I'd also like to add my acknowledgement of the traditional owners of the lands from which we're meeting today. I'd also like to warmly welcome you, all of our members, for joining us this afternoon, whether you're here in the room or the many who are joining online. Thank you for taking the time to be with us. As Joan has said, this year marks ESS Super's centenary, 100 years of serving those who serve Victoria. It's an amazing milestone. While anniversaries are a chance to reflect on the past, they're also a great opportunity to look ahead. For me and the executive management team, the centenary is about how we build on that legacy to ensure ESS Super remains firmly member-focused while becoming more agile, more responsive and better equipped to support our members' evolving needs. ESS Super's purpose has always been clear: to do everything in our power to help our members achieve the secure and comfortable retirement they deserve. This purpose defines our energy and guides every decision we make. It comes to life every day through the service and support our frontline teams provide to our members. In the past year, our Member Service Centre responded to almost 80,000 calls, with members waiting less than 2.5 minutes on average, a statistic we are very proud of. Our dedicated case management team supported nearly 200 members with complex issues, taking responsibility for resolving them on behalf of the member with empathy and efficiency. Our member and employer administrative support team resolved 89% of almost 16,000 detailed queries within 5 business days. Helping members make informed decisions is another cornerstone of our service. Last year, our member education consultants conducted almost 9,000 one-on-one appointments, visited more than 100 workplaces across Victoria, and ran 78 education events in person and online, including a few here today. Our financial planners provided tailored advice to more than 400 members. They deeply understand the complexity of ESS Super accounts. That's expertise that's hard to find elsewhere. From the 1st of July, we partnered with Guideway Financial Services to further enhance this support, giving our advisors greater capacity while maintaining our profit for member ethos. Our regulatory framework requires us to have an external partner to authorise our financial planners, and it was important to choose one that shares our commitment to acting in members' best interests. This arrangement will add valuable oversight and support, ensuring that personal advice our members receive is high quality, accessible and aligned with their financial goals. This year, we also stood beside members facing some of life's hardest challenges. Our claims and insurance team supported nearly 400 members and their families through death or disability claims last year, guiding them through the process with compassion, understanding and respect. That level of responsiveness and care matters, because we know that the work our members do is demanding and often stressful. Our role is to make sure that when you come to us, you get clear answers, guidance you can trust, and the reassurance that your retirement savings are in safe hands. We know that sometimes things don't go as they should, and when that happens, we take it seriously. Listening to complaints and resolving members' issues are always top priorities and a key focus for the board. Just as importantly, we review every complaint to identify any opportunities for improvement. For example, feedback from members of the SERB scheme highlighted that our resources weren't meeting their needs. In response, we've created a tailored SERB scheme handbook and a dedicated page on our website. I'm pleased to say that members overwhelmingly tell us that we are getting it right. In the last financial year, members gave our frontline teams an average satisfaction score of 93%. And this year, as Joan mentioned, independent research by Investment Trends, which is an independent research house, ranked ESSSuper #1 for member satisfaction across the superannuation industry. Recognition we're immensely proud of. Beyond service, we've also introduced some important initiatives to strengthen retirement outcomes. In March, we launched a new website developed around member feedback. Easy to navigate, written in plain English, and designed to put members in control. It's built on a modern platform that allows us to keep refining and enhancing the site to meet the evolving needs of members and their employers. We've also expanded our on-demand education resources to help members build financial confidence. Our Exploring Super podcast series covers everything from investment trends and parental leave to cybersecurity and the First Home Saver scheme. We've also launched a 4-part video series designed to help members plan for a secure and fulfilling retirement. During the year, we also introduced a new default investment option, Balanced Growth Managed, which has a higher allocation to growth assets than our previous default, positioning members for stronger long-term returns. And from 1st of July this year, the new ESSSuper Defined Benefit Fund members began contributing at a default rate of 7% post-tax, helping them maximise their benefits from day one. These changes all reflect our determination to make ESSSuper stronger, simpler and more supportive for every member. Our investment approach continues to deliver. I'm pleased to report that all ESSSuper investment options outperformed their inflation-linked objectives for the financial year to 30 June 2025. Our balanced growth option delivered returns in the top 25% of Super Ratings balanced peer funds, another independent ratings agency in our industry, with several others also ranked in the top quartile over 3 years. These results demonstrate the strength of our strategy and the calibre of our team. Daniel, our CIO, who you'll hear from shortly, will provide more detail. But for me, the key message is we remain committed to delivering strong, sustainable outcomes that give our members confidence about their financial future. Of course, it's not just about growing members' super. In this day and age, it's also about protecting it. Cybersecurity and data protection remain critical priorities for ESSSuper. Threats such as identity theft and data breaches are real and, unfortunately, increasing. At ESSSuper, we apply strong security controls, ethical data practices and privacy standards to safeguard your super and your personal information. We're committed to ongoing investment in this area to ensure your personal data and retirement assets remain safe. However, while I have you all here, it's an opportunity for me to remind you that keeping your information safe is a shared responsibility. We have strong controls in place, but you, our members, also play an important part in protecting your own assets. That means keeping your contact details, and especially your mobile phone number, up to date so that our multi-factor authentication process works. You must always use strong and unique passwords for your different accounts, and you must never share your passwords with anyone. And please remember, ESSSuper will never contact you or send you an email or text message asking for your personal information or your member's online password. If something doesn't look right, please get in touch with us using the contact details on our website. Turning to administration, in January, our previous administrator, which was a company called Iris, sold its superannuation administration business to a new company called Apex, with the change taking effect on the 1st of June 2025. For members, services have continued as normal. At ESSSuper, we see this transition as one that creates an opportunity for us to build a stronger partnership with our administrator, a very important service provider for the fund, to allow us to improve systems, strengthen processes, and ultimately deliver better outcomes for our members. Some of you may remember that ESSSuper commenced legal proceedings in the federal court against the previous provider, Iris, who up until June this year were our administration provider. That decision was not taken lightly, but reflected the seriousness of the issues that we faced and our determination to protect members' interests. We continue to work through the steps of that legal action to ensure we achieve an appropriate outcome for ESSSuper. As we look beyond our 100th year, our focus is clear. ESSSuper remains absolutely committed to protecting your super, delivering the service you deserve, and investing in the people, technology and systems that make this possible. Most importantly, we'll never lose sight of our mandated purpose, to act in your best interests and to ensure that every member can look forward to a secure and comfortable retirement. Before I close, I want to take a moment to acknowledge Joan's extraordinary contribution as the Board President and Chair of ESSSuper. Joan has led the ESSSuper Board with wisdom, integrity and an unwavering commitment for almost a decade. She's guided the fund through significant change, always with our members' interests, your interests, at the forefront. I've greatly valued the opportunity to work alongside her for the last 3.5 years. On behalf of the management team, our people and our members, I sincerely and wholeheartedly thank you, Joan, for your leadership, your stewardship, and the lasting legacy you leave with this fund. And now, as I close, I want to turn to you, our members. Thank you for your loyalty and trust to ESSSuper. It is our privilege to support you through your careers, through life's challenges, and into your retirement. We are very proud to serve those who serve or have served Victoria, and will continue to do everything we can to ensure your super works for you. Thank you.
Thanks very much, Robbie. Our final speaker today is the Chief Investments Officer, Daniel Salutin. Daniel joined ESSSuper in June 2018 and leads the organisation's investment function. He has held senior roles in asset allocation, investment strategy and asset consulting at several organisations. Prior to joining ESSSuper, he worked at a leading institutional investment consultancy, Frontier Advisors, providing investment advice to Australian superannuation funds. Dan is committed to helping members build wealth for their retirement. He holds a first-class honours degree in finance from the University of Melbourne and is a CFA charter holder. Over to you, Daniel.
Thank you, Christian, and good afternoon, everyone. Welcome to our annual members meeting. My name is Daniel. I head the investment team here at ESSSuper. I'm pleased to be with you here again this year to talk about investment markets and to give you an update on how your investment options have performed over the year. I'd like to start with a couple of important points just to set the stage, if I may. So for our members with a defined benefit fund, your super isn't impacted by investment markets. The value is really determined by the rules governing your fund. So if you do have any questions in relation to that, we do have some member education staff here today who can help. And for those with an accumulation plan or a retirement option, the super is very much impacted by investment markets, so it's important to pick an option that fits your tolerance of risk, that takes into account how long you plan to be invested for, as well as your personal goals. That being said, our default option, which Robbie and Joan mentioned earlier, Balanced Growth Managed, that has been designed to be a great choice for many of our members. So with that out of the way, I'd like to talk a little bit about investment markets and what's been happening in the last little while. For those of you who were here with us last year, you may remember I gave a fairly cautious outlook for growth assets last year. Looking back, that caution was at least partially justified. Early in April, we had the US announce a set of tariffs which caused a very sharp market correction in April. That downturn was fortunately fairly short-lived. It was primarily contained to the fund's equity investments, and other growth-exposed areas of the portfolio, such as credit or private assets, property, infrastructure, they were fairly stable, which signalled to us that the investors and people, they weren't necessarily panicking, they were rather trimming positions that had already done quite well for them. And so you can see on the chart on screen, in many cases, that involved selling big technology names who are standout performers over the year and are increasingly becoming very popular among everyday investors. Other developed markets also delivered positive returns, although most lagged behind the US market, which is really becoming the epicentre of the artificial intelligence boom. Europe's recovery has been encouraging but uneven. France has been slower to bounce back. In the case of Germany, it's implemented some targeted fiscal support and some increased spending in the defence sector, which is providing a bit of a tailwind in some of those sectors. And in the case of Australia, we are seeing some early signs of improvement. We're seeing some more household spending. We're seeing some renewed interest in the housing market, coinciding with some lower interest rates, which have been good. And business confidence is picking up in Australia, but we're not necessarily seeing a lot more in the way of increased investment activity. That said, the Reserve Bank has taken a very cautious approach in terms of what to expect going forward from further interest rate cuts. Inflation does remain a concern. Some of you may have noticed last week with the release of the CPI, we did get a rather unexpected jump, which jolted markets on the day, and that followed a period of quite a lengthy period, actually, of a general downtrend in the CPI. Emerging markets have also staged quite a rebound this year. They've been helped by a weaker US dollar. That's eased some of the debt pressures impacting those countries, and it's improved the investment outlook in some of those regions. That's varied from country to country, and to a significant degree it's been driven by the manner and the degree to which US tariffs are impacting those specific countries and how their own economic cycles are playing out. China remains a very, very large emerging market index exposure. It's a very difficult country to read. It's dealing with some weakness in the property sector and a cautious consumer, which is saving more than spending. Turning to bonds, bonds are the fixed income parts of the portfolio. The returns have been pretty modest over the year, but still positive. They've been helped by lower inflation and falling interest rates. We are, however, starting to see some longer-term rises in interest rates as a lot of governments in the world are beginning to run increasingly large fiscal deficits. Which brings me to my next topic of gold. So gold prices have been a pretty stellar performer this year. You can see the chart on screen that shows the gold price in US dollars adjusted for inflation. And you can see that a big part of that recent rally that we're seeing recently is quite extraordinary from a historical point of view. It's been driven by buying pressure, not only from central banks but also individual investors that have been buying gold. Gold has historically been a pretty reasonable store of value, especially during periods of inflation. And while inflation's come down in a number of countries, it does remain stubbornly elevated in others. Tariffs, which you may have read about in the news, they generally add to inflation, as do government debt levels. As the government borrows more, it tends to have an inflationary effect. Also, geopolitical tensions are playing into this mix as well. There's a lot of news about China and other countries seeking to diversify what historically has been very high allocations to US treasuries. They're diversifying that into gold as well. None of these factors have in any way dented the performance of growth assets over the past year in particular. We've now seen 3 consecutive years of double-digit share market returns. The chart on screen is the Dow Jones Industrial Average over the past 100 years. The Dow Jones is a long-running index of 30 very, very large publicly traded companies in the United States. Interestingly, over that entire 100-year period, we've only seen 5 instances in that history where we've had 3 straight years of double-digit gains. On one of those occasions, it was 5 years of double-digit gains, and that was right in the lead up to the big tech crash, which some of you may remember from the early 2000s. While it's true that markets often slow after periods of very strong returns, what matters most is time in the market, not attempting to time the market, and I've prepared a chart to try to make that point. So the chart you see on screen is the value of $100 invested in that Dow Jones index in the 5 years leading up to the tech wreck. You can see from the chart, if you're a very, very good investor and you predicted the tech wreck, as a number of fund managers did, kind of 2 years prior to it happening in 1997, and you took yourself out of the market, if you look at the subsequent history, go forward from that, you really didn't put yourself much ahead of someone that was invested throughout the entire period. Said another way, staying the course often gets you a better result than sitting in the sidelines. And ESSSuper and our internal team, we do make portfolio allocation adjustments to every investment option to help smooth the ups and downs of the market cycle. Before I move on to discuss the product performance, I'm pleased to share that our investment fees have fallen across most investment options this year. Our default balanced growth managed option has an investment fee of 0.43%, which places it among some of the lowest cost offerings amongst the largest Australian superannuation funds in the industry, which is a terrific result. I'll come back to the balanced growth managed option shortly, but I'd like to take you through investment performance. So over the 3-year period ending 30 September, the performance you see on screen was in Robbie's presentation as well. It's generally above inflation-linked objectives. You may recall a year earlier, inflation was much higher and performance was generally below inflation objectives. So it's pleasing to see that as conditions are normalising, we're seeing performance improve as a result. Moving on to performance relative to peers. This next chart on screen shows our 3-year numbers against super ratings median peers on a 3-year basis ending September. The gap that you're seeing there, we are generally above median for most of the options, but that gap has narrowed in the past couple of years relative to when you take a longer term perspective and look at, for example, the 5 years prior, ending 30 September. You'll notice also on the chart that the balanced growth option continues to be a standout performer, and I want to spend a brief moment to talk about that because it does highlight some important environmental factors that we're facing in investment markets today, which I think would be a useful takeaway for everyone here today. I've simplified that previous chart by kind of narrowing the scope of comparison. Here we see the 1-year return to September of balanced growth, the balanced growth managed option, and the median super rating balanced fund. So for some context, the balanced growth option is our lower cost option, and the balanced growth managed option is the default for accumulation members. The two options are identical in their construction. They have the same mix of growth assets. The only practical difference, which is impacting the result you're seeing on screen, is the balanced growth option, which has had that stellar performance that you're seeing there. It's invested entirely in passive equities. Passive equities track the share market rather than trying to outperform the share market. And so there's no discretion in in what the fund managers invest in. They invest in the broader market. Having said that, every other asset class within that option is actively managed in the same way that the balanced growth managed option is actively managed. So it's an important distinction. This isn't an indexed option. By contrast, the default, the balanced growth managed option, that's got a much higher allocation to active equity managers, which is to say it's got a much higher commitment towards a number of professional fund managers that we've employed to select the stocks that they think will outperform the market over the market cycle. And unfortunately, over the prior year, that strategy has not kept up with the passive style of investing, and it's been to varying degrees, but it's really reflected the fact that the active managers have been very cautious about chasing rising equity markets in the sort of environment that we're facing today. This isn't unique to our mix of fund managers. We're seeing this very broadly impacting the statistical majority of professionally managed equity strategies, both in Australia as well as globally. These periods are not unique in history. I think the magnitude of the current period is reasonably unique. They do resolve themselves eventually. And it goes without saying that we've obviously appointed fund managers that we're confident have done the work, that know the stocks that they're investing in, and we certainly believe that that work and that knowledge should translate into outperformance over the market cycle. Let me close by thanking you for the trust you place in ESSSuper to manage your retirement savings. I look forward to addressing any questions in the Q&A session shortly, and I'll be available after today's presentation for any one-on-one questions anyone has. Thank you very much.
Thank you, Daniel. Well, that concludes the formal presentations. We hope you found them informative. It's now time to hear from you in our question and answer session. We'll cover as many questions as possible today, but if we don't get to yours, please don't worry. All questions will be answered and published on our website by the 4th of December, along with a recording of this meeting and the minutes. If your question is of a personal nature, our member education consultants are available after the meeting or between 9 a.m. to 5 p.m, Monday to Friday, in person or online. What we'll start with is a pre-submitted question. We had questions submitted in advance of today. This particular member, or number of members, have asked the following question: how does being in a defined benefit scheme affect my retirement outcome compared with a regular superannuation account? I might address that to you, Robbie.
Thank you. A very, very important question. Defined benefit super is different and complex, and it can sometimes make the comparisons difficult, and especially for new members. We work really hard to make sure we educate them about the benefit they have, but it can be confusing, and it can even be sometimes complex for CEOs, so I've got some notes here. We do point often to the comparatively higher retirement balances that demonstrate the value of our scheme for members. So if we just look at the moment at our emergency services defined benefit members, they currently retire on average with balances more than 3 times greater than the average Australian superannuation account holder. 78% of our active defined benefit members are on track to meet or exceed the Ask for Comfortable standard when they retire, whereas in the general population that's only 30%. So 78% hitting that target as compared to 30% in the general population. However, the benefits and advantages of a DB fund are a bit more complex than those average figures show, and so I might just step through those. As well as helping build a significant balance over time, a defined benefit scheme is also more consistent and secure. Because your benefit is based on a set formula, it's generally easier for you and more predictable for you to understand what you're going to receive. So Daniel showed some charts that showed how markets can go up and down, and while over the long term they will generally increase, with a DB it is, because it's based on a formula, you're not exposed to those ups and downs in the market. There's also not ongoing annual fees and costs for your defined benefit, as they're built into the structure of the scheme. So the formula shows you what you will get. The ESDB, which is designed specifically for emergency services workers, it has also been designed understanding the risk and demands of being a first responder and doing emergency services work. As a result, it provides very generous death and disability benefits, which provides members and their families with additional peace of mind. Given the nature of our members' roles, securing comparable insurance in the commercial market I don't think would be possible, but certainly if you're able to get it, it would be prohibitively expensive. In our defined benefit, these death and disability benefits are built in. You don't need to opt in, and there's not additional premiums. One important aspect of defined benefit funds is that it does reward longer service. So the length of your service and the outcome that you achieve increases over time. So your DB benefit will increase with the age and length of your service. However, to ensure members are not disadvantaged, there is a requirement in our legislation for us to apply what's called a minimum requisite benefit. So, like all aspects of our DB entitlement, it is something that is provided for in our legislation. So the minimum requisite benefit, or MRB, is basically a safety net, and it applies to ensure that members are not disadvantaged when compared with an SG fund. It is a legislative requirement, so when the SG requirement was introduced across the economy, it was also expected that DB funds ensured that there was that safety net when compared with SG obligations. We employ an independent actuary who supports us in determining how this MRB formula works, and there is a different MRB for the different schemes because they're not all the same scheme. The way the MRB formula works has to be accommodating the different schemes of designs. So given the average age of an active SSF member is pretty close to retirement, I'll focus on the ESDB. So when a person leaves their emergency services employer, and thus the DB scheme, we compare two figures, the amount that they would get under the DB formula, and then we also compare it to the minimum requisite benefit. Whichever is the higher is the amount the member gets. So the MRB applies also if the benefit is payable to a member in the circumstances in which they've become disabled or passed away. As I said, it's based on an actuarial formula that uses a number of inputs, but fundamentally it's there to kind of replicate what an SG account would look like were the member receiving SG contributions. So the formula works off what would the SG contributions be. So they have been adjusted as the SG has gone up from 3 up to 9 and then from 9 up to 12. It looks at the contributions the members made. It adds investment returns and applies the very strong investment returns that the ESDB pool achieves. And it also, like an accumulation account, makes an adjustment for fees and expenses to the account. But it is effectively a safety net, and it operates such that you get the high benefit whether you are, better off under the DB, you'll get the DB. If you're better off under the MRB, then you'll get the MRB. And the relationship between the two fluctuates at different times. As I said, the DB tends to improve as you are in longer service and as you get older. But there are a few other things that will impact the relative relationship between those two figures. We're very committed to transparency, and I want to make sure that members can access clear information. And so I have to say this hasn't been an area where we've had a lot of interest from members in the past, but we have had some interest of late. And so we are working to make sure that we produce clear, concise explanations of how this formula works so that members can have confidence in this important aspect of the scheme's design. So we will be updating our website and including that information on it as soon as we've completed that work. So I hope that makes that a little bit clearer, and we're happy to take some other questions.
Thanks, Robbie. I'll take a question from the room.
Yeah, hi. China now, their economy is larger than the U.S., right? And that's a recent phenomena. So what I'd like to know is, are we swinging the share market investments towards Chinese share markets? Can you elaborate on that, please?
I think that's you, Dan.
Yep, happy to talk to that. So China is an allocation that's prevalent in the accumulation plan. I wouldn't say it's a wholesale shift into China. The Chinese growth story has been in play for a long time. If anything, the growth rates are starting to slow down. Some of the geopolitical tensions that I mentioned earlier are making it more complicated for Western-oriented financial institutions to generate the sort of returns that are risk appropriate in that market. So it is a market that we're still invested in. I wouldn't say it's overweight, but it's part of the emerging market allocation, which includes countries like India, which are actually by a number of accords pretty well placed to generate some positive performance going forward.
I've got a question from one of the online audience members. So Shirley's asked, does ESSSuper invest in gold in the growth investment option? I think that's probably you again, Dan.
Yep, I'll take that one as well. We currently don't have any exposure to commodities in any of the investment options. The reason we do that is structurally to invest in gold, you would need to have a particular view of the price of gold, which we think is speculative in nature. We'd much rather invest in companies that are performing repeatable processes that are generating a dividend or a return that's repeatable on a go-forward basis. You can make money in gold. It tends to be something that's difficult for a super fund to do. And it tends to be much shorter term than the time horizon that we would typically be looking at investments with.
Thanks, Dan. We've got a pre-submitted question that we'd like to address. So this is from Michael, and he's asked, what were aggregate-related party payments? Robbie, are you happy to address that?
Yes, thank you. So unusually, under the structure that we report under, we include some executive and board remuneration, and that is counted as part of related party payments. So most of the related party payments relate to executive and board remuneration. It also includes some very modest expenditure on partnerships with industry associations, and we do provide a breakdown of all those related party payments on the AMM page of our website, and also in our financial statements in our annual report, should you want to look up that information. But the majority of it is executive and board director remuneration.
I just want to ask, Robbie, can you elaborate what the actual role of the administrator is? I drew a blank on that.
Sure. Sorry, I should have elaborated. So it's very common in superannuation that you engage a company that helps to support some of the back office function that is undertaken by the fund. So processing of contributions, processing of forms, so the things that help money come in and payments go out. So you need a very sophisticated platform that stores all that information, and we've been working to try and ensure that much more of the processing that we're required to do, because we have a very big payroll here in terms of the pensions that are paid to all our members, is done in a way that is as automated as possible, because it reduces risk and it reduces cost. We outsourced to Iris, I think it was about 4.5 years ago now, and then the new provider, Apex, has bought that business in June this year. So when the decision was taken to outsource to that provider, one of the really important decisions that the board made, and Jode might want to elaborate on this, was the touch points with members was something we were not prepared to give to someone else. We knew that that was a really important relationship and a way that we ensured that we maintained a level of service to our members. the administrator is the company that operates to help us with all of the back-end admin functions, money coming in, money going out, and the processing of all the data that enables that to happen.
We've got a question from the online audience. So Martin has asked the following question. To what extent, if any, is ESSSuper influenced by the government relating to investments in their stated priorities? Dan, can you take this one?
Yes, I'm happy to take that question, and thank you, Martin, for the question. I think the kind of the root of the question is answered with the statement that every investment that we make is made purely with members' best interests in mind. We will not invest in anything that compromises that objective. Having said that, superannuation is a highly regulated sector, and so there are certain industry acknowledged government benchmarks around how we consider and frame investments in different asset classes, but they're really there as a form of benchmarking and to make sure that what we're investing in is meeting that baseline level of return. But to summarise, every investment, they're not government related investments. They really are designed to meet the risk and return objectives of each of the investment options.
Thanks, Dan. We've got another pre-submitted question here. It's just from Shirley. She's asked, what's the difference between balanced growth and balanced growth managed? Are fees higher for the managed fund? And third part, did balanced growth outperform balanced growth managed last financial year? Dan?
Thank you, Christian. There's a few questions, and we had this one on pre-submission, so I included a lot of this content in the slides that I spoke to earlier. Very, very simple terms. The reason balanced growth managed is a little bit more expensive is because it has active equity managers, so it has professional fund managers that pick stocks that they think will outperform. Otherwise, the two options are dead on the same in terms of the underlying portfolio exposures. Both of those options are highly, highly competitive on a total fee basis. They're not expensive options by any measure against the largest superannuation funds in Australia. And the magnitude that we're talking about being 0.2%, I think is roughly the difference in the fees. Net returns are a much, much bigger impact there than fees will ever be for those two options.
Excellent, thank you.
If you get an inheritance, would you invest in a super environment, or would it be better to invest outside the super environment?
We probably can't answer questions that are of a personal nature. I mean, there's a range of benefits to investing in super. There are limitations because of the tax-preferred nature of superannuation. There are limits to the amount of money that can be contributed in addition to your employer contributions. But I think if you would like some guidance in relation to kind of something that's a little bit more personal, we're really happy to set up a time for you to have a discussion with a member ed or an advisor.
I've got another question from the audience. The gentleman at the front here.
My question relates to the change to the 7% default contribution rates and the notice that was sent out to members on the 30th of May this year detailing those changes. I've got a copy of it here if you wanted to look at it while I ask the question. Would that exist?
No, I think you can just ask the question.
Lovely.
Yeah.
In the event notice, ESSS offered projections for members as evidence of the benefit of the change to default contribution rates. In the examples that you gave, the 0% contribution example represents an accrued benefit multiple of 2.55. Your example affords a final average salary of $130,000. So the projected benefit for that individual is $331,500 under the accrued benefit multiple. The amount shown is $517,000, which is an increase of 55.9%. That is, as I understand it, the increase for minimum requisite benefit. From the calculations made, the accrued benefit multiple lump sum was improved by 55.9% to achieve compliance, and the fictitious member represented in the projection of 0% contributions never sees an amount calculated via a multiple. despite it being a projection of 30 years to retirement. This means the fund's multiple system is forecast to be irrelevant for members who choose not to contribute. My question is this the real reason behind the change to the default contribution rate earlier this year?
Thank you for your question. As we've sought to stress, the decisions we make are ones that are based on what's in the best interests of members. So the default contribution change was made because when the process of onboarding people, when we made our admin change, everything became digitised, as is happening across a number of different environments. When we didn't have the opportunity to talk to members as they're filling out the form to make sure that they understood the impact of different contribution rates, we saw that it was not something that members understood, and the default rate at that point was 0. And so that's what most members ended up with. And we could see that really was damaging to members' long-term interests if they were not paying attention to it. So in financial services, there are many occasions where a default decision is made on behalf of a member, like the default SG rate that applies in our system. It's not even default, it's compulsory. Because we know that people don't often pay attention to superannuation until they're older, and by that time they don't have the opportunity to accumulate the amount that they'll need for retirement. So we undertook a project where we did detailed research of members to understand the inattention to their contribution rate, and to test with them the idea that if we made the default rate what we think will help them achieve an adequate retirement, would that be better? So the research was resoundingly, and this was across a large number of members that was done by an independent agency, was really clear that members said, we want you to have the default settings set in a way that will be in your interests, in our interests. So the change we've made is to change the default contribution rate from 0 to 7, but it's been done at the same time that we have enhanced the way that we support member decision making. So every time there's a new set of recruits, Christian is the head of the member education team, Christian or a member of his team goes out to brief the members to help them to understand the default setting that's been made and to give them the opportunity to understand what their options are, and should they wish to make a change to that default rate, then, to understand how they do that, but importantly, what the implications are. So we will continue to monitor this and understand the impact on members, but it was absolutely done with the best interests of our members in mind.
Would you happy to take a follow-up question on that, Robbie?
Well, it's just quite detailed and technical, so I'm probably happy to have a follow-up conversation with you, but maybe not in the context of the annual member meeting.
I've got another question here. So Margaret has asked, how does ESSSuper compare to other funds? Joan, would you like to address this one?
I'd be very happy to. I think that, a lot of what we said today will support my answer, and I'll probably repeat a few things that have already been said as well. We're really a consistently high-performing fund across all the key measures, but because of our unique structure, it's really difficult to compare our fund with public offer funds. We're not among the top 10 big guys, the big Goliaths, but actually that's a real positive for us and for our members, because we're large enough to deliver really strong financial outcomes, but we're also small enough to maintain, close, really meaningful, bonded relationships with the communities we serve, and to understand their needs really quite intimately. I think I mentioned, and Robbie mentioned, we're outstripping, our retirees are really outstripping the national average in terms of the money that they have collected in their fund when they retire, and our active defined benefit members as well are all sitting up in that high Australian to meet or exceed the ASFA standard for retirement income. That's an important piece. So, to make a sort of direct comparison is very difficult. And so the answer to the question becomes more complex than we would like, obviously, for you. The investment returns are also really important. And I think you've just seen again or heard again that our investment performance delivers those really long-term growth despite all the volatility that the global conditions create. And I think overarchingly as well, we consistently deliver much better service, much higher quality service than other funds in the system. And I think that's demonstrated by the Net Promoter Score, the commitment that our members have to us, the way our members deal with us and engage with us, and also the independent surveys that measure how we perform as well. And those are quite complex survey assessments of performance across a whole range of elements. So I think it's hard to compare. It's not an apples for apples comparison, but I think the metrics that we deliver on and are really, really important to us, as we've demonstrated in our speeches to you today, are the core things that tell us that we're going well and that we're doing really well for our members' best interests.
A question to Daniel. You put up a slide showing the annual return, market return, with Australia at 10%, and every other country, except thankfully France, is less. Why is that? Is it because we're mostly banks, or is it some structural issue in Australia? And does this divert your investment funds away from Australia, or can you put some insight on that?
Absolutely. Happy to talk to that. We do have a structural overweight to global equities. It is a much larger universe of investment opportunity. There's a much larger number of stocks that we're able to access when we go global. I think what you're seeing on that 1 year basis, it's really been driven back by there's a general kind of level of growth that's permeating everywhere. Interest rates are coming down, people are still shopping and buying, and things are progressing well. So that's what you're seeing in Australia. What you're seeing kind of globally, thematically, that AI theme has been a big industry and a big driver of that outsized performance that you're seeing, but also certain industries where there's some exposure to manufacturing, that's seen a recovery. The defence spending sectors in particular, largely US based, they've seen some uplift in performance as well.
We don't have manufacturing, or we have what?
We don't have a big AI sector, is the kind of the single point summary. We're a smaller economy. We're undergoing some challenges with productivity growth. It's still a pretty positive story overall. I think it's a very lucky country to live in. We've got a lot of resources. There may be some tailwinds coming up from some of the rare earths and the deals that our government's making with the United States. It's certainly not a negative story. I think a double-digit return's a pretty good outcome, but when you're looking at shorter periods, a year or even 3 years, you can get some pretty significant divergences. Even looking back, 1 year ago, emerging markets really didn't look very crash hot, and you'd be equally right to be asking why, what's going on there. And this year they've had a cracker of a year.
We've got a question from an online member. This is Adrian has asked, what percentage of total investment revenue is paid to investment managers?
The simplest way to answer that investment fee that we charge at the investment option level, that is largely, by and large, 99% paid to the external investment managers that oversight the portfolio, the security selection. We do have an investment team in-house that looks after those managers, that manages the contractual relationship, that makes sure that those fees are as sharp as they can be, and we do benchmark that, and we've spoken to that a little bit today. I haven't provided the full suite of numbers, but the next product disclosure statement will have some positive news for most of our investment options.
And just because Dan is perhaps a little bit too humble to answer that question as powerfully as he should, it's been a really strong focus of the investment team. Obviously, we look to produce the best investment outcomes that we can, but the guaranteed way you can make sure you're improving your net outcome is through a dedicated focus on reducing investment fees. So our actively managed balanced option is really one of the top performers when you look at fees alone. I mean, it's always important to look at your net outcome, and on that, we've also shown you our very strong performance. But if you look at just fees alone, our fund is one of the highest performing in terms of comparatively the work we've put into reducing our investment fees.
I've just got a pre-submitted question addressed, and I'll get to some more people in the room. So this one was from Anna, who's asked, can you explain how revised scheme pensions will be treated if the proposed new superannuation tax scheme is implemented? I'm happy to address this one.
And perhaps, I think it is relevant not just for revised scheme members, but for all DB members.
Yeah, anyone on a pension. So the government is still sort of settling the rules of how defined benefit pensions are going to be assessed. So, and they're going to be valued under the Division 296 ruling is what this member's asking about. So for the 3 million threshold test, the value of the lifetime defined benefit pension would likely use the family law method that's in place at the moment. And it's a present value calculation using age and sort of gender-based factors. But again, it hasn't been legislated yet. So we anticipate that members would be able to pay this liability up front, or defer it with the ATO keeping a debt account that accrues interest until those benefits are paid. But again, only a small number of defined benefit members are expected to be affected by this with a $3 million threshold. But again, the legislation hasn't been approved as yet. So once we get more information, we'll be letting our members know as soon as possible.
Just with regards to the holding account and also the crediting rates, for members, just for the benefit of members, what markets are the holding account exposed to in general in comparison to other areas within ESS?
I think that's the lump sum account.
Yeah.
Sorry, the lump sum account, is it correct, Jess?
Yes, so the lump sum account is effectively invested in the SSF scheme, so they're a pool of assets that's managed by the Victorian Funds Management Corporation. The detail about their asset construction is probably best accessed through our annual report, so we provide information about that. But it is also a diversified strategy across a range of different asset classes and very strong performance. I think over the past 10 years, the SSF has returned 8.5%, so a very strong return, reflecting an orientation towards growth assets. But if you would like further information, I'd probably direct you to the annual report, and if you still have questions after that, then feel free to reach out.
I've got a pre-submitted question here we need to address. It's from Louise. So she's asked, I understand ESSSuper is a signatory of the United Nations Principle for Responsible Investment. Can you please confirm if ESSSuper invests in companies that have investments and or operations in illegally occupied territories and contribute to the economic support of human rights violations against Palestinian people? Dan, that would be for you.
Thank you, Louise, for the question. This was a pre-submitted question, so I have been able to get some of the details to help answer this. So the accumulation plan has a very, very small exposure to equities that are listed or domiciled in Israel. And in terms of magnitude, we're talking 0.01%, so that's 1% of 1%. So it's a very minimal allocation. The allocation relates to passive global equity investments. So to provide some context, the fund managers that are appointed to manage that allocation really have no discretion in which stocks they buy. They're tasked to invest in an industry benchmark, which is called the MSCI World Index Benchmark. It's a regulated benchmark. It's a very cost-effective way of getting global equity exposure, and there's really no discretion from a funds manager point of view in how they handle those holdings. Speaking more broadly about the investment program, we are guided by responsible investment policy. This is a policy our board approves annually, and it's available on our website. That policy has been guided by the United Nations Principles for Responsible Investment, and we've been, as a fund, as an organisation, signatories to those sets of principles since 2007. And under that policy, we are precluded from investing in certain companies that are involved in what's considered controversial weapons. So it's things like cluster munitions, it's other types of weapons systems. And importantly, to provide some colour and context as to how that works, it is a risk-weighted approach. So we appoint a specialist service provider that researches companies globally, and they have a risk weighting that applies to companies as to the likely risk of their involvement in these areas. And it is necessarily a risk weighting. That does reflect the complexity and the evolving nature of supply chains. It also just speaks to the practicality of differences in public disclosure standards. When you kind of venture outside Australia, the world can be a weird and wonderful place. And so what that practically means is there'll be investments that are in the funds today that may be weighted a higher risk tomorrow that are subsequently divested. And then conversely, if there's a company with, it may be a subsidiary that's involved in something that's not permitted under our responsible investment policy, if they divest that exposure or that contract ends, they may become investable again. So it is a complex issue to manage over time. We do offer members the ethical diversified option as well. That does have a broader set of exclusions, and it takes both a financial as well as a non-financial lens on those exclusions. So for members that are interested in that, I'd suggest having a look through the PDS materials for some further detail on that.
Thank you, Dan. I will take a question from the audience.
Two questions. The first one is concerning investment headwinds. With inflation increasing, unemployment increasing, is stagnation a possibility, which is disastrous? And the second one, an easier one, is in the revised scheme, you get 2 CPI increases. Why isn't that the same as inflation? Same rate as the inflation rate?
Dan, you want to do that one again?
Yeah, I'm happy to talk to stagflation for all. We haven't seen stagflation for an awful length of time. Certainly, it featured more prominently as I was a younger person going through the investment industry. I think there is a general kind of opportunity, I suppose, for complacency that, given a lot of the people that are investing today, they haven't necessarily seen that market for some time, and I think the inflation shocks that we're seeing lately have taken some time to work through the system, and people are dusting off some of the older models that used to apply in the past. I think it's very difficult to say where we're sitting today that stagflation's a certainty. I think it's certainly a focus for central bankers globally to try to avoid that. I think the best view I can potentially express forward is we've had a cracker of a run in the last 3 years. It's not unusual for things to slow down. We're not necessarily entirely bearish on things. It's really hard to see and to know with complete certainty where AI will go. Certainly it's having a pretty phenomenal impact, at least within our own investment team, in uplifting how we do things. And that's why, unlike the tech wreck, you're actually seeing some of those earnings supported by, business models that have the potential to make some real money. So I don't have a direct answer for if stagflation's around the corner, but it's certainly something we're monitoring and we're trying to position things with a long-term view. and being very prudent about how and what stocks we buy, and that's why we do think that active management's kind of a sensible place to be, which is sort of why I spooked that option earlier today.
So I think CPI is a measure that's used to reflect what the inflationary environment is.
So it's a smaller amount than the actual CPI, than the actual inflation rate. When we get the CPI increase, it's less than the actual inflation rate.
Oh, yeah.
It's normally sort of an annualised rate that we use. Yeah, so we get that twice yearly, and it's an annualised rate, so you don't see the full one each time there. And it's an average of all the states as well that we use here when we apply it against the pension. So it's not just sort of Victorian specific, it's an average of all the states when we apply the CPI. But yeah, if you like, maybe have a chat afterwards and we'll see if we can get some information for you.
Yeah, I was wondering, is it the actual inflation rate or...
All right, we have time for one final question before we wrap up today's meeting.
Just two questions. One that in reading that I've done lately, and I'm by no means an expert, but in some reading that I've done, there seems to be this view emerging that we are one of the wealthiest countries in terms of our superannuation per capita, and two, that because we don't have a lot of industry, we are sort of going to implode on ourselves unless we invest elsewhere at a greater rate. So that's question one. Well, I asked the second one, which is sort of fairly simple and straightforward as well. Yeah. And the second one is just curious, with the binding death benefit, which again, it's been in the media that a lot of people are quite oblivious to the fact that they need to actually make such a thing if they want their money to go to, or their superannuation to go to certain people. Why is it that after we do it, take that action to make it, we are told that you'll have to do that again in 3 years?
Thank you.
Which, particularly for people, hopefully not myself, but particularly for people that are aging who may not have, the greatest memories or maybe distracted by a number of things, it's plausible that 3 years elapses and they're oblivious to that fact.
Yeah, so the case for investing overseas, I think it's less a matter of the country necessarily imploding on itself. It's more just where can we find the best opportunities for a dollar to be invested. And as the superannuation industry gets larger and larger, there are fewer and fewer assets domestically to be investing in. And when you go global, there are different players in the market, so they're not other superannuation funds, and so you're competing with different investors with different costs of capital, and there are kind of niche assets globally which fit very well for the sort of risk-return profile that Australians are looking for, which is why you've seen a lot of supers begin to look offshore, and we've done that as well, and obviously after a certain amount of size, the ASX is. It's got its limits in terms of how big it is and how big an investor can be in any individual stock. So that is also just a practical reason for why you kind of get to a certain size and then you need to go offshore.
Thanks. So with the binding nominations, so obviously they're a legally binding document there, and so what we like to do is make sure that they're still current. So when it expires, what we do is we write out to members via their inbox and members online, and what we actually do is do a secondary letter as well if they haven't resubmitted it. And if it's the same person, you just click the button and it will roll over again for that period of time. But we want to make sure that it's still relevant, because if someone was to put it in place and then not touch it again for 20 years, their situation may have changed completely, and there's no reminder that comes to say, is this still valid? And so that's what we do. We do it every 3 years to make sure it's still in place.
Because it does bind us. So
it's really important that it's
if the member is no longer married to the same person, for instance, and we're bound to pay it, maybe not the outcome that the member would have liked.
Yeah.
So the trick is, though, to renew it before it expires, because then it's an online process.
Well, that's all we have time for today. I'd like to sincerely thank you all for attending our annual members meeting. We really appreciate you taking the time to engage with us and share your views. I speak for all of us at ESSSuper when I say we feel privileged to serve you and are committed to doing everything that we can to help you achieve the best possible retirement outcomes. I hope you've given you a sense of that this afternoon. Bye for now.